Rocket Lab just did the rare space startup trick. Record revenue, record backlog, a narrower loss, and a balance sheet suddenly loaded with cash from selling stock while the stock was hot. This is Earnings Unscripted for posterity. It's May 7th, 2026, and we're looking at Rocket Lab, ticker RKLB, Q1 2026. They launched Electron rockets, build spacecraft and satellite components, and they're still trying to bring the bigger Neutron rocket to life. So, strong quarter, but not uncomplicated. Miro?
The print was better than the market mood. Revenue hit $200.3 million, a record, just over the top of the prior guide, and up roughly 12% from Q4. Gross margin was 38.2%, above the 34 to 36 guide, and up a hair sequentially. EPS was a 7-cent loss, better than the 9-cent loss last quarter. I don't have the street EPS number handy, but directionally, this improved.
And still a loss-making rocket company, so feet on Earth?
Yes, Gravity remains undefeated. Operating loss was $56 million, but what changes the conversation is the balance sheet. $1.48 billion in cash and marketable securities, over $2 billion of available liquidity, and backlog now at $2.2 billion. That is a very different risk profile than, please fund my rocket dream.
Tiny compliance parachute before we get fully nerdy. None of this is financial advice, just our personal opinions. And yes, parachute metaphors near rockets make me nervous.
Only nervous if they deploy late.
The earnings day ration was weirdly theatrical. It sold off more than 7% during regular trading, popped after hours, then faded on the call and settled around 8.20, down about 3% versus the prior close.
Which makes sense. Kind of. Investors liked the record numbers, but they also saw the bill. Free cash flow was still negative $77.4 million, better than Q4's negative $114, but still real burn. And the cash pile came partly from very aggressive at-the-market stock sales. Great execution, also dilution. Both can be true.
That's the Rocket Lab personality, isn't it? Elegant engineering, aggressive finance, and Peter Beck sounding like pain is a procurement strategy.
More than slightly. The segment split is the real tell. Space Systems did $136.7 million in revenue, up almost 32% sequentially. Launch was down. So the company's becoming less cute small rocket provider and more defense space supply chain. Satellite buses, solar reaction wheels, and now laser communications through Mynaric.
And sometimes literally Mars hardware. Motive's robotic arm on NASA's Perseverance rover is now in the Rocket Lab family.
It is. No, that's the point. This is not just PowerPoint space. Their stuff moves, points, powers, and sometimes touches another planet. But next quarter, revenue guidance steps up to $225 to $240, while gross margin is guided down to 33 to 35%.
So success has a tax. Bigger government satellite work and Mynaric add scale, but margins get squeezed.
Exactly. That's the hook. They are buying suppliers because supply chain pain made them angry, raising cash because the stock gave them the window, and pushing Neutron through tests where Beck basically said, if something breaks now, assume it was intentional.
Comforting in the way only rocket testing can be comforting.
Strong quarter, serious ambition, very expensive proof still ahead.
All right, let's get into the details because that cash raise and the buy the pain acquisition strategy are where this quarter gets really interesting.
Yeah, and I think those are actually the same story. The cash raise and the acquisitions are not separate footnotes. They are Rocket Lab trying to turn a hot stock price into control.
Control as in fewer suppliers ruining your week?
Exactly. But start with the cash because this is a genuinely impressive finance. They sold stock through the ATM at average prices around $26, then $48, then $70 a share. That brought in about $450 million in Q1.
So they basically used market enthusiasm as a fuel source.
Yes. Dilution fuel, which sounds ugly, but if you are building Neutron, ugly can still be rational. The choice is not dilute or don't dilute. It is often dilute while the stock is loved or dilute later when you're desperate. They chose the former.
Okay, but does that make it good capital allocation or just convenient timing?
Fair question. I would say good timing with a grade still pending on allocation, because cash on the balance sheet is not automatically value. It becomes value if it buys time, compresses execution risk, or lets them acquire capabilities they actually need. Otherwise, it's just a very expensive comfort blanket.
And a comfort blanket shareholders helped sew.
Right. And one odd thing, small but important, is they can't just turn around and return capital freely. The 10K says under their Department of Commerce direct funding agreement, they need prior U.S. government approval for dividends or buybacks.
Wait, so the cash has a directional bias? It's going into operations, factories, Neutron, M&A, not shareholder candy?
That's the point, which brings us to Beck's acquisition philosophy. He basically said the quiet part out loud. Quote, some of these acquisitions are just driven by pure pain. And then he points to electric propulsion being late, expensive, painful, and says owning those things means you can resolve the pain.
That is such a founder sentence, not strategic adjacency, just this vendor hurt me, and now I own the category.
It is almost spite as industrial policy. But in space, that may be reasonable. If one component is late, the whole satellite is late. If the satellite is late, the manifest shifts. If the manifest shifts, revenue timing breaks. So vertical integration is not just ego, it is schedule insurance.
But schedule insurance can get pricey, right? Mynaric is the obvious example.
Right. Yes. Mynaric adds roughly a $15 million quarterly revenue run rate, but management was clear it comes in at lower margins and needs work. The CFO used the phrase fighting shape, which is doing a lot of emotional labor there.
Corporate translation, we bought it, and now the adults have to find the missing tools.
More or less. And Beck also said he treats these acquired businesses like startups. They have to pitch him for money. They're expected to grow, run fast and hard. That is great if Rocket Lab can impose operating discipline. It is dangerous if every acquisition becomes a little project demanding attention.
So the bull case is they're building a space supply chain inside the walls. The bear case is they're collecting fixer-uppers while also building a medium-lift rocket.
That's it. And there's another accounting wrinkle here. Q1 OpEx looks strange. GAAP SG&A jumped because Beck's RSU cancellation accelerated stock comp expense. Non-GAAP SG&A actually benefited because executives waived their 2025 bonuses, reversing accruals.
So neither side is fully clean. Up is not really up, down is not really down.
Exactly. Don't build a trend line off that. The cleaner signal is operational. Gross margin beat in Q1, cash burn improved, but the next phase brings lower margin scale from big defense satellite work and Mynaric.
Which is such a funny success problem. You win bigger contracts, you buy strategic capability, and your margin percentage gets punished.
Welcome to aerospace. Dollars arrive wearing steel-toed boots. The question is whether those lower margins are temporary onboarding costs or the true economics of being a prime-ish space system supplier.
And underneath all this is Neutron, quietly eating capital and attention.
Not quietly. It is a rocket. But yes, the interesting little tell is that R&D headcount fell partly because people moved into production cost centers. That is not a layoff story. It suggests Neutron is moving from laboratory expense toward manufacturing reality.
Or attempting to.
That distinction matters. Rocket Lab is not being valued like a sleepy component supplier. It is being valued like a company that can turn backlog, cash, vertical integration, and Neutron into cadence.
So the deep dive version is this quarter wasn't just record revenue. It was Rocket Lab buying time, buying control, and accepting some margin bruises to do it.
Yes. And now the outlook question is whether investors have patience for that trade, because Q2 is where the scale story and the margin squeeze show up at the same time.
Yeah, and patience is such a fragile word here because Q2 is basically management saying, good news, we're bigger. Bad news, the percentage math gets uglier.
Exactly. They're guiding revenue to $225 to $240 million, so the top line keeps stepping up, but gross margin drops to 33 to 35%.
That's not a disaster, it's a signal.
A signal that scale is arriving wearing, what did you say, steel-toed boots?
I stand by the footwear analysis. The key is whether this is onboarding friction from Mynaric and defense programs, or whether investors have to reset what good margins means for Rocket Lab at this size.
And then Neutron is still the emotional centerpiece. Even if Space Systems is doing the financial heavy lifting, the market's imagination is strapped to that rocket.
Right. Beck said something very Beckish about demand. He said he lies awake worrying about things, but Neutron demand is just not one of them. I like the confidence. I also want the tank tests to agree.
That's the whole story, isn't it? The demand sounds real. The balance sheet is suddenly much safer, but the proof is still physical. Metal, carbon fiber, engines, cadence.
And integration. Mynaric has to be fixed without becoming a distraction. SDA work has to convert backlog into clean revenue. Neutron has to move from heroic engineering to repeatable manufacturing.
So if I'm watching next quarter, I'm not obsessing over one margin print. I'm watching whether the lower margin comes with better operating rhythm.
Yes. Less drama per dollar of revenue. That's the metric they don't print.
Sadly not in the 8K.
It should be.
All right, so Rocket Lab leaves us with a very strange but compelling picture. More cash, more backlog, more control, and still a giant execution bill coming due.
That's fair. Ambition is no longer the question. Delivery is.
Perfect place to park it. Thanks for listening, everyone. We'll wrap things up from here.
If you'd like these earnings drops to just show up when we publish them, following the show is the easiest little habit cue. And small transparency note, this episode was AI assisted with source notes grounded in Rocket Lab's earnings release, filings, and call transcript. If you've got feedback or a ticker you want us to tackle, send it to earningsunscripted@datamadness.ca. Thanks for being here and take care.
See you next call.